Welcome to the Economic Bulletin, where we present comprehensive coverage and expert insights on key updates regarding pivotal economic trends and financial shifts. We begin with the United States. The Federal Reserve Governor, Adriana Kugler, has expressed strong support for the Fed's recent interest rate cuts and signaled her readiness to back further reductions if inflation continues to ease as she expects. Speaking at a European Central Bank conference on Tuesday, she emphasized the need for a balanced approach between controlling inflation and supporting the labor market. Kugler noted that the labor market is showing signs of cooling and that the Fed is keen to prevent a sharp slowdown. While last week's job reports showed positive resilience, she highlighted that the Fed would not rely on a single data point, but rather focus on broader trends. Moreover, the Federal Reserve Bank of New York President John Williams said in an interview with the Financial Times that further rate reductions by the central bank will be appropriate over time following September's significant half percentage point rate cut. Williams aligned with Fed Chair Jerome Powell's stance that the bank will likely stick to smaller quarter-point rate cuts and isn't rushing into more aggressive actions. He also noted that the monetary policy is currently well positioned to support economic growth and bring inflation back to 2%, adding that he expects rates to come down gradually in the future. Still in the U.S., where trade deficit experienced a notable decline in August as exports rose and imports dropped, indicating that trade may pose a slight hindrance to economic growth in the third quarter. The Commerce Department's Bureau of Economic Analysis reported that the trade gap decreased by 10.8%, settling at $70.4 billion, compared to a revised figure of $78.9 billion in July. Trade has negatively impacted gross domestic product for 2 consecutive quarters. Current projections for growth in the third quarter are as high as 3.2% on an annualized basis, following a growth rate of 3% in the April to June period. Moving to Europe, market researchers Kantar reported that annual grocery price inflation in the UK climbed to 2% in September from 1.7% in the prior period. The report highlighted that prices for chilled soft drinks, chocolate confectionery and skincare products are rising the fastest, while household paper products, dog food and cat food saw the steepest decline. Kantar also noted that the UK grocery sales decreased on a monthly basis from a 3% growth reported last month. Deutsche Bundesbank President Joachim Nagel indicated that the German economy is likely to experience another year of contraction, with the US election posing an additional risk to Europe's growth. He suggested that as the Federal Minister of Economics had predicted, the second half of the year would likely be weak and that a slight recession in 2024 could not be ruled out. Nagel also expressed concern that a return of Donald Trump as US president could lead to increased protectionism and trade restrictions, which he believed would not be beneficial for a global economic growth and would present challenges to Europe. Moving to China, the World Bank has forecast that China's economic growth will further weaken, projecting a decline from 4.8% in 2024 to 4.3% in 2025. This slowdown is expected to affect regional economies in East Asia and Pacific, where growth is anticipated to decrease from 4.8% to 4.4% over the same period. The World Bank noted that while recent stimulus measures may provide a short-term boost, sustainable growth will require deeper structural reforms. The bank highlighted that China's slowing growth, combined with shifting trade dynamics and increasing global policy uncertainties, could create additional challenges for neighboring countries. In a notable escalation of trade tensions, China has imposed temporary anti-dumping measures on brandy imports from the European Union. The tariffs, effective October 11th, will require importers to pay security deposits ranging from 34.8% to 39% of the import value for various European brandies. China's Commerce Ministry accused the EU brandies of being sold at an unfairly low price, which threatens local producers in China. The investigations has also targeted European pork and dairy products, indicating potential further measures.